There's a mistake I find in almost every contractor's QuickBooks file the first time I open it. And it's a quiet one. It just sits there, it hides, it doesn't throw an error, red flags, may not even pop up in your reconciliation. But it can make the business look like it spent thousands of dollars it didn't, or hide thousands of dollars that it actually did. And it all comes down to one thing that most people think is just boring data entry: entering bills and paying your vendors. By the end of this video, you'll know exactly how it's supposed to work, and more importantly, how to tell in your books in about 60 seconds if yours are broken. And a little bit of quick context on why I care about this so much. I'm Austin, I run accounting for trades. We do bookkeeping for HVAC, plumbing, and electrical businesses, and that's all we do. So I'm not coming at this as some generalist who learned QuickBooks from a course. I open contractor books every single week, and I see the same issue over and over again. From Ferguson statements to Johnstone invoices to Home Depot runs, let's get it fixed. Why even bother? Isn't accounts payable just busy work? Well, done right, it gives you 3 things that you can't run a trades business without. 1, you'll always know who and when you owe somebody. And that's the foundation for any good cash management system. 2, your profit on your P&L will be accurate always. It won't be missing some random vendor that you haven't paid yet. 3, you've laid the foundation for a solid job costing system. Now, done wrong, all 3 of those will break. You won't know who you owe, your P&L is gonna lie to you, and your job costing is non-existent because you don't have a system in place. Hey, real quick, I want to clarify what we're talking about today. In QuickBooks, there's 2 ways that money can leave your bank account, and they're not the same. If you pay a vendor on the spot, say swipe the credit card at the counter, check out at Home Depot, that's a single transaction. The money leaves right then, right there. It's going to be considered an expense or a check inside QuickBooks, but it's just a one touch and you're done. Now, if a vendor gives you terms, that's a bill. You owe it, and it takes 2 touches to get it to clear out. First, we'll enter it as a bill inside QuickBooks, and then second, we have to schedule a payment or mark it as paid when we actually pay it. So it's 2 steps versus an expenses 1. And that leads to one of the most common mistakes that I see. So here's the scene. You enter a bill from Ferguson. QuickBooks now knows that you owe them $4,000. Great. Well, then you pay it. Also good. And then a few days later, you see inside your bank feed that $4,000 leaves the checking account, memo Ferguson, and you're like, oh yeah, job materials. So you click add and send it right to the job materials account. And boom, that's it. That's the leak. You just told QuickBooks that you spent that money twice. Once when it was inputted as a bill, and again once it's in the bank feed. Now your material cost is showing double than what it actually is. Your P&L is going to show that you're making way less money than actual. And so now your numbers are just flat wrong. And now it's an easy fix. You just have to know what's going on inside of your QuickBooks from a bookkeeping side. So whenever you're using that accounts payable bill workflow, that payment that's in the bank feed that you added as job materials, you need to make sure that is matching to the bill as a payment. Now, QuickBooks does a pretty good job of auto-matching a lot of this stuff, but it's not perfect, and that's why you need to understand what is going on. So when you click match, you're connecting the dots and telling QuickBooks, hey, I paid this bill, it is done. But when you match that as a payment, it doesn't count it twice on your P&L as job materials, and that would fix that duplicate issue you would get if you click add. So add is the leak, match is the fix. Now you might be thinking, wouldn't my reconciliation catch this? Well, yes and no. It depends on how thorough your reconciliation is. If you're only reconciling your bank and credit card accounts, well then you'll only see one transaction there and that'll reconcile perfectly. If you're reconciling your vendor accounts and making sure that your accounts payable is clearing out every month like you should, then you would catch it there when you find that that bill is still sitting as unpaid. But that's where you have to be careful. If you're not reconciling your vendors, then you'll never catch this. That bill will sit there forever and ever, and you'll have an incorrect P&L. So that's kind of the 2 parts to reconciliation as well. It's not just, hey, did it all balance out? It's what's sitting uncleared and why is it still there? That stale pile is where we find a lot of our leaks. So if you've got bill payments from 8 months ago still sitting uncleared, that's probably a sign you need to do a little bit of cleanup. And you can check this right now. Log into your QuickBooks and either look at your bank feed and see how your vendor payments are in there, or even check the categorized section of your bank feed and look to see if they've been matched or were added as materials. If they were added, you might have this leak. All right, one down. This next one is where you really can't see your margins. So your supply house, Ferguson, Wind Supply, Johnstone, whoever it is, they send you a monthly statement. There might be 30, 40 deliveries on it across, half a dozen jobs, a dozen jobs. And what do I find that a lot of guys do? Well, they just pay the whole statement in one lump sum, code it right to job materials, and boom, bada bing, they're done. Why this can be a leak? There's a couple reasons. So it's a trade-off. While paying the whole statement as a lump sum is definitely fast, it does reduce your visibility. That additional visibility can help in two ways. One, it can help you with job costing. If you allocate each of those line items on that invoice to a specific job, you've already started down the process of job costing. Now, two, it also catches if the supply house is overbilling you, right? Did they put the wrong price? Did they double the delivery charge? Was there a return that never got credited? If you enter the bills the way the material actually arrives, using the invoices or the receipts that you get on a more day-to-day basis, you'll be able to actually reconcile against the statement that the vendor's providing and catch these errors. And now, I'll be straight with you. That is absolutely more work, especially if you're doing 40, 60, 80 deliveries a month. You're not gonna wanna hand key every single one of those into QuickBooks. There are tools to help with this. So you can use, my favorite is called Dext, D-E-X-T. It's a wonderful tool that does all the OCR data entry for you. You just review and approve. Some supply houses will even link with QuickBooks now. I would avoid having to do a whole bunch of manual work to get this detail, but know that extra detail in will get you more useful information on the flip side. So leak number 3 is setting the foundation for job costing. And it's gonna be the difference between running a real trades business or just running a checkbook. So every bill in QuickBooks has a column that most contractors and bookkeepers just completely ignore. And that's gonna be the customer project column. So when that $4,000 of Ferguson pipe goes in with no job attached, QuickBooks has no idea what job ate that cost. And so that means your job costing's dead before it even started. And it's an easy fix. Implement a PO structure so that way every purchase that you're making has a job number assigned to it. That means every material, every subcontractor bill, everything that you're making is using a job number or is marked as overhead. That way you clearly know and have put thought into what that cost is for. If you do that consistently, you input your vendor bills, you'll have a great foundation for job costing that's largely just missing some labor. And inside QuickBooks, it makes it pretty easy where you can just allocate it to that customer or project, and then you can run reports down the road that show you your margin by those projects. And if you do that consistently over a long enough period of time, you'll be able to start looking at patterns and say, hey, this install ran at a 38% gross margin, but this service work was running at a 70% gross margin. And that's where you'll be able to determine where you're more competitive, where you need to increase prices. You'll be able to find some of these smaller issues in your pricing or efficiency. So a quick asterisk on that last section. Everything I said about hand tagging items inside of QuickBooks to allocate them to a job or a project, that's the QuickBooks workflow. If you're running a field service software like ServiceTitan, that workflow can be improved and much more efficient. What I recommend for ServiceTitan is that you use the purchase order system to allocate all of your vendor invoices, bills, receipts, anything tied to the job right inside of the ServiceTitan system. It's gonna have more searchability. It's easier to do. We can have the technicians even do it. It's that easy on the mobile app. It's just a much more robust platform than QuickBooks job costing options. Not to mention, that ServiceTitan is already gonna have your labor in there. And again, it's just one less thing you have to do. It'll all be automated, that much more live and easy for you to use. You're already paying so much for ServiceTitan. Leverage all of its functionality to make sure that the job costing lives there. So QuickBooks will be your books, your accounting, it'll have all of your overhead. ServiceTitan is everything that's gonna make up your gross margin and cost of goods. Let the two systems do what they do best and don't fight them. And leak number 4 is the one that turns up at 2 a.m. and keeps you tossing and turning all night long. It's that, do I have enough money in my account question. If you pay a vendor the second that the money's available or as soon as you receive that vendor bill, well, you're throwing away one of the most useful reports inside of QuickBooks called the Accounts Payable Aging Summary Report. So what this will allow you to do is when you actually enter bills, you can tell you in one glance where you actually owe money and when it's due. And that's the basis for cash flow, because you'll be able to see, oh, I need to pay Ferguson in 30 days, so I need to make sure I set aside some money in my checking account to do that. It means you're gonna stop getting surprised by cash crunches and you can start seeing what's coming. And you can take that a step further. You can also stop missing those early pay discounts if you are, have good cash flow. And on 6 figures of materials a year, that 1 or 2% supply house discount for paying within 10 days instead of 30 can actually really hit that bottom margin. So the fix here is simply just anything that you're not paying on the spot, enter it as a bill inside QuickBooks so you can pull the report and see when you're gonna be owing money. And then you can just run that accounts payable aging summary report every Monday. It'll take you 1 or 2 minutes and you'll see who you owe and when, and it's a great basis for a cash flow system. Really, all you'd have to do to add on top of that is likely payroll and then some buffer for your typical overhead for items that you are spending, right at the counter. So what I want you to do, go run that accounts payable aging report right now. See what vendor bills are inside of your QuickBooks. If it's blank, then you don't know anything about your upcoming bills. It means you're flying blind. But hopefully you have something in there and you can start using that as a cash flow management tool. I got 3 quick ones for you. Vendor credits, make sure you're entering those alongside of the invoices. That way your vendor account will always reconcile to the statement that they provide you. If you return materials, make sure that's getting inside of QuickBooks as well. If you have duplicate vendors, if you have Ferguson Industries, Ferguson Plumbing, make sure you're merging all of those in QuickBooks to try to keep everything clean. And third, stop dumping everything into a miscellaneous supplies account or an Ask My Accountant account. Just make sure you're categorizing things with a reasonable level of detail and accuracy so that way the data and your P&L is actually useful to you. Now, I know what a lot of contractors are probably thinking at this point, if you've made it this far, because I hear it every time. Well, this is a whole lot of data entry and I'm busy. And that's a fair point. It really is. There's some softwares to help speed that up, but let's make it more worth it. If the accuracy and the job costing portions aren't enough for you, there's another thing I think is really important, and that's the end of the year W-9, 1099 shenanigans. It's one that I see a lot of owners really struggle with, and accounts payable is really the best way to enforce it. If you don't have a W-9 on hand and it's valid, that vendor doesn't get a check. It's an easy rule to implement that avoids your subs from taking your money, running, and never communicating with you again. Now, ideally, you don't have those kind of subs, but we all can think of some that we've met that do that. So now, instead of chasing that guy in January, you would already have it mid-year, and you have all the documentation that you need to file that 1099 in January, and it makes the process so much smoother. And while you have the invoice and the money in your possession, that's when you hold all of the power. So don't pay them until you receive the W-9. And one last thing, clean payables and having that solid cash flow foundation is what's gonna make you look like a real company to a bank or a bonding agent. They'll get a really good idea of how much you owe on a monthly basis and they can understand your cash flow better. And that makes it much easier for line of credit applications, bonding, They want to see that you're a real business. They want to see the accounts payable. It's proof that you're not just quietly buried in a mountain of other debt. So it's a great thing, and it starts here with this bill entry. Vendor bills feel like the most boring thing you could be doing inside of your business. And you're not wrong, that's part of the accounting side. But how you enter them and how you pay them really decides what you owe and who you owe and when you owe it. Cash flow. It decides whether your profit is going to be honest on whenever you pull a P&L. It decides whether you ever see what job is actually making you money via a job costing PO structure. And it can help you with those W-9s, pesky tax season. So getting accounts payable right and everything downstream will just get easier. Get it wrong, and every number you look at can be a little bit of a lie to you. Now, you don't have to be a bookkeeper to fix this. All you need to do is know that yours is doing it right. And we've already showed you a couple reports to pull inside of QuickBooks to do a double check on that. And honestly, most of the contractors I've worked with had no idea that this was off or that it should be something they should be doing until somebody asked or started looking into it. If you're not sure if your books have any of these leaks or if they have anything else, feel free to grab a spot on my calendar for a free 30-minute call. We'll take a peek at your books, we'll dive in, we'll find and double check that your systems, your processes, and your bookkeeping are accurate so that way you have the numbers you need to drive decisions in your business. If you don't have time for a call, then check out my free resources at least. There's some DIY scorecards in there that can really find some leaks inside of your business. Links in the description. Choose whichever path works best for you. Comment, DM, let me know if you need any additional help. By all means, hope you guys have a great year.